Let's see the 14th problem. Professor Raj, resident, enters into partnership with three other persons on July 1st, 2018 to start a manufacturing business. The following capital assets are contributed by him as his capital contribution. So here the assessee is going to contribute the capital asset as a capital to the partnership formed. So in such a case where the amount which has been recorded in the books of accounts of the firm has to be taken as the gross sale consideration, not the fair market value on the date of transfer. So the date of acquisition gold 10/6/2002 and shares unlisted is 2/11/2003. Fair market value on the date of transfer is rupees 6 lakh and 3 lakh for unlisted shares. Amount recorded in the books of the firm is rupees 5,90,000 and 8,50,000. So this will be taken as a gross sale consideration. Cost of acquisition rupees 2,10,000 and 2,70,000. And if you check, both the asset are purchased after the base year, that is 1/4/2001. So the purchase price will be taken as cost of acquisition. Next, on 10th April 2019, he completes the construction of a residential house for which he spends rupees 10 lakh 40,000. So here the assessee can claim the exemption under section 54F because the section they have clearly mentioned that the assessee should sell any long-term capital asset. He can sell any long-term capital asset, and after selling that asset, he need to purchase the house property, that is residential house property, within 1 year from the date of transfer and within 2 years before the date of transfer, and within 3 years you need to complete the construction of such residential house property. If you check that the assets has been transferred on the date called as July 1st, 2018, and he completes the construction of the residential house property on the date 10th April 2019. So within 3 years we have completed the construction. We can claim the exemption under section 54F. Next, determine its net income from capital gains for the 11th assessment year 1920. CI value for 2001 and 2 100, for 2 and 3 105, for 3 4 109, 18 19 to 80 rupees. So go with the solution. So first calculate the period of holding. So for gold, take the purchase date which has been given in the problem, that is 10/6/2002, and the gold has been transferred on the date called as July 1st, 2018. So the purchase date is 10/6/2002 and transfer date is 1/7/2018. Unlisted shares, it has been purchased on the date called as 2/11/2003 and it has been sold on the same date, that is 1/7/2018. So this is the period of holding. So based upon that, check the chart and identify whether it is a long-term capital asset or short-term capital asset. So the gold will fall under the other assets category. So if it is used for more than 3 years, long-term capital asset; less than 3 years, short-term capital asset. So since it has been used for more than 3 years, it will be called as long-term capital asset. Unlisted shares will fall in the fourth category. So if it is used for more than 2 years, it is long-term capital asset. If it is used for less than 2 years, it will be short-term capital asset. So it has been used for more than 2 years, so even it is the long-term capital asset. So for claiming the exemption under section 54F, the asset should be long-term capital asset. Right? Okay. Next, take the value called as gross sale consideration. So gross sale consideration is nothing but the amount which has been recorded in the books of accounts of the firm. 5,90,000 for gold and 8,50,000 for unlisted shares. Next, from that, minus the realization expenses. So the realization expenses, they are not given in the problem. We have to take as nil and nil for unlisted shares. So the balance amount, that is net sale consideration, is 5,90,000 and 8,50,000 for unlisted shares. From that, minus the index cost of acquisition, because both are long-term capital asset. So the formula is cost of acquisition divided by CII of purchase year into CII of transfer year. Since the asset has been purchased after 1/4/2001, the purchase price will be taken as cost of acquisition. So check the cost of acquisition, that is 2,10,000 for gold and 2,70,000 for unlisted shares. So take the value. Cost of acquisition for gold is 2,10,000 and for unlisted shares is 2,70,000 divided by purchase year. So the purchase date is 10/6/2002. So this will fall in the financial year called as 2 and 3. So check the CII value of 2 and 3 is 105. So take the value 105, not 5 into 280, because the sale or transfer year, that is in the previous year 18 and 19. 2018 will fall in the previous year or the financial year called as 18 and 19. So the CII value of the 18 and 19 is 280 rupees. We'll get the value 5,60,000 as an index cost of acquisition for gold. Next, calculate same for unlisted shares. So the cost of acquisition is 2,70,000 divided by CII of purchase year. So the unlisted shares has been purchased in the 2/11/2003, and this date will fall in the financial year called as 3 and 4. So the CI value of 3 and 4 is 109 rupees. So take the same value 109 into transfer, that is the previous year 18 and 19, 280 is the CI value. So after calculating, we get the value called as 6,93,578 as an index cost of acquisition. Next, if any additions have been made, minus the index cost of improvement. But in the problem, they are not given any additions information. The index cost of improvement will be taken as nil. So after that, we'll get the balance that will be called as gross capital gain. So for gold, 30,000, and for unlisted shares, we have 1,56,422. Now, since you can claim the exemption under section 54F, but there are two assets, that is gold as well as unlisted shares. So you need to calculate the order of preference, because you need to claim the exemption for one asset and you can go for the another exemption for the other asset. So order of preference will be calculated, that is on the basis of percentage of gross capital gain to net sale consideration. Means we need to calculate the percentage of the gross capital gain to the net sale consideration, because we need to identify the order of preference. Means for which asset we need to settle first, or we need to claim the exemption first, and which asset we need to claim the exemption next. So percentage. So for gold, gross capital gain is 30,000 divided by net sale consideration is 5,90,000 into 100. So we'll get the 5.08%. Next, for unlisted shares, the gross capital gain is 1,56,422 divided by net sale consideration is 8,50,000 into 100. So we get 18.40%. Clear? So whenever there are any or there is more than one long-term capital asset, so just calculate the percentage of gross capital gain to net sale consideration to identify the order of preference. Okay. Now, so after calculating the percentages, we came to know that 18.4% for unlisted shares and 5.808% for gold. So first preference will be given for unlisted shares and second preference will be given for gold. So for shares, calculate the exemption amount. So whenever you are calculating any exemption amount under section 54F, first understand the conditions that if the cost of new asset is more than net sale consideration. I'm repeating, if the cost of new asset is more than net sale consideration. If the cost of new asset is more than net sale consideration, then entire gross capital gain will be claimed as exemption. Clear? If the cost of new asset is more than the net sale consideration, then gross capital gain will be claimed as an exemption. So check the cost of new asset. So the cost of new asset is rupees, that is 10,40,000. Correct? Now, what is the net sale consideration of the unlisted shares? Is unlisted shares is 8,50,000. Correct? So the cost of new asset is 10,40,000, but the net sale consideration is 8,50,000. So in such a case, entire gross capital gain will be claimed as exemption. Understood? So the gross capital gain, that is 1,56,000, 1,56,422 is the exemption amount. And since after calculating the exemption or after claiming the exemption for unlisted shares, we have the balance. What is that balance? That is for gold, the balance is the cost of the new asset is 10,40,000, and already we have claimed the exemption for unlisted shares, which are in the net sale consideration is 8,50,000. So the balance amount is 1,90,000. Is the value which is available for gold to claim the exemption. Okay. Exemption. Now apply the condition. If the cost of new asset is more than net sale consideration, then the gross capital gain will be claimed as exemption. And if the cost of new asset is less than net sale consideration, then we need to apply the formula, that is gross capital gain divided by net sale consideration into cost of new asset. Clear? So I'm repeating the condition. If the cost of new asset is more than net sale consideration, then the value is gross capital gain will be claimed as exemption. But if in case if the cost of new asset is less than net sale consideration, then we need to apply the formula, that is gross capital gain divided by net sale consideration, gross capital gain divided by net sale consideration into cost of new asset. Right? So for gold, the exemption amount will be, so the remaining amount is 1,90,000. Now check with the net sale consideration. So actually the cost of new asset is 1,90,000, not the 10,40,000, because already we have claimed the 8,50,000 for the shares. So the balance amount is 1,90,000 as a cost of new asset. So the cost of new asset is 1,90,000 and the net sale consideration is rupees 5,90,000, which is less than the cost, sorry, which is more than the cost of new asset. So claim the or apply the formula, that is cost gross capital gain divided by net sale consideration into cost of new asset. So for gold, the gross capital gain is rupees 30,000 and the net sale consideration is rupees 5,90,000. So take the value 30,000 as a gross capital gain divided by net sale consideration is 5,90,000 into cost of new asset is 1,90,000, not the 10,40,000. So take the value, that is 1,90,000. So the value exemption amount is rupees 9,000 9,661. This will be the exemption amount for gold. So they calculate the balance amount. So gross capital gain is 30,000 and the exemption amount is 9,661. So the balance amount is 20,339. Now for unlisted shares, the cost of the gross capital gain is 1,56,422 and the exemption amount is 1,56,422. So the long-term capital gain is nil. Understood? We'll go to the next problem. Problem number 15 is a problem. Mr. Prasad sold a residential house property for rupees 12,10,000 on 15th May 2018. So the date is 15th May 2018, but the previous year 18 and 19. The index cost of acquisition of the property of rupees 2,27,500. So they only given the index cost of acquisition. Mr. Prasad holds 51% of shares of ABC Limited on 1st December 2018. The total investment made by Prasad in ABC Limited is 8,50,000, out of which the company made the following investment. This is the following information. On 1st March 2019, invested A new plant and machinery, rupees 4 lakhs, 20,000. And on 10th July 2018, invested in old plant and machinery, rupees 1 lakh. And on 31st March 2019, amount deposited in long-term for long-term